Hi, I'm Scott Zoldi, Chief Analytics Officer at FICO. It's a great pleasure to spend time today talking about the use of transaction data within the context of credit risk. This is a really important area today where firms are embracing open banking and trying to enhance their credit risk decisions based on using this transaction data in conjunction with traditional credit lending. And I'll spend some time today talking about how that works and what some of the benefits are of using open banking data and transaction data within credit risk decisions. So, what are we looking at? We're looking at a system where a consumer provides consent to share data from their existing banking relationships to make an improved decision with a new entity. So, for example, in this diagram, um, the consumer in the green sweater has a relationship with Bank B and Bank C, and they want to share their data through an through open banking and through a preferred PSD2 provider of data to make a decision. That data contains a tremendous amount of value and needs to be created into set of analytic assets that can be used to enhance a credit decision. Once those attributes are produced or a score is produced from these transaction data, it can then be used to make an improved decision for Bank A and ultimately for the consumer. And that's where the value proposition comes in, is that the consumer consents to share the information and get a better outcome. Now, why is transaction data important? Well, here I have a diagram of two customers, customer A and customer B, and I've summarized their data. And you can think of cash as money going into the account and merchandise as outflows out of their, let's say, current accounts. And customer A and customer B look pretty the same when you summarize data. And much of what's happening today in credit risk is based on static information or summarized information. But if we look at the transaction data over time, we see that these customers are not the same, right? Even though the summarized data looks very similar, customer A has inflows into their account somewhat sporadically, whereas customer B has a regular set of inflows of funds into these accounts that suddenly stop. And so it provides a different context for who these consumers are and potentially provides an ability for us to better understand. Potentially, customer A is part of the gig economy and their income is sporadic. And maybe customer B, unfortunately, has lost their job. And these are two things that are very important to understand when you want to make a credit risk decision. So, what are the technologies that we can use to make these decisions? Well, first of all, there's a lot of transaction data. And so we use a set of technologies called behavioral analytics. Behavioral analytics takes all this transaction data and summarizes it into the attributes that describe that time based transaction data. It's looking for the current state of the customer. Let's say what is the latest inflow, but also changes. So we could look at their current balance at the current time. We could look at changes of inflows this month compared to the last 3 months. We could understand whether or not the purchases as a function of balance has gone up or down in terms of the available funds that they have. And this all can provide very interesting insights to a transaction-based analytic associated with credit risk. So one should think about that transaction data as a set of these attributes that are summarizing the transaction data over time. Now, once we've been able to do that, we create unique transaction-based attributes that can be used and combined with traditional credit lending. And so one has to build a model. And these models can be built in a couple different ways. I'll illustrate two different ways of tagging or creating the outcome data on which we would build this model. This diagram represents a customer that has two accounts today. And so we have the open banking data associated with those transaction data over 12 months, and we would have a performance window. And if we wanted to build a model to understand whether the customer would go bad in the future and become delinquent, we could create two different tags. Tag one could basically look at whether or not either of these two existing accounts go bad, right? And so this model would predict whether, let's say, the consumer would go bad independent of whether we would offer them a new line of credit or a new banking relationship. Whereas tag two, a different tag, could basically say, listen, I'm not going to focus on the performance of their existing accounts. I want to understand if I've provided them a new account, will that go bad in the future or not? So there's two different ways to create tags here. One is, what is the credit capacity of a consumer based on account one and account two? The other is whether or not we provided them with a third trade line. Would that cause them to be in a situation where they may become delinquent? So there are design decisions here, but the concept is that we're going to use all the information from the 12-month period and the transaction information to make a prediction whether tag one or tag two in terms of whether they are more likely or less likely to become a credit risk from origination's perspective. So we take the open banking transaction data, we create these behavioral profiles, which will look at changes in their transactions over time in terms of ratios and changes in current states of the customer. And we'll use the traditional originations data and traditional lending behavior data that would come through the today's systems. And it gets combined within a machine learning model. What I represent here is a neural network-based model. And what comes out of that is an enhanced open banking origination score that takes the best of the credit lending decisions and processes that are in place today from a financial lending perspective, and also represents the customer's consented sharing of their transaction data to enhance that credit lending decision. Now, what is the value of this? Well, one of the best ways to think about value is the fact that every model that's developed from a credit risk perspective is trying to differentiate between good and bad customers. So what I represent here on the left-hand side is a performance plot that data scientists would look at. And so we have a score. It goes from the highest score to the minimum score. And here I'm plotting the difference in terms of how many bad or accounts that will become delinquent are detected by a model versus how many goods are detected by the model, the false positives. And so when you build a model like this, what you're trying to do is you're trying to maximize what we call the KS metric. And this KS metric basically says how much better is the model at detecting bads from goods. And so when you build one of these models, what you're really trying to do is detect most of the customers that would become delinquent and minimize the number of good customers that would be incorrectly flagged by this model. And so what's interesting is when we look at the value of transaction-based data, we see a pretty significant improvement in the KS, upwards of 5 to 15%. And moreover, right, we can see that we have types of customers, for example, young accounts who are current that have a limited history, let's say, with the traditional bureaus and traditional sort of trade lines, which have a very significant improvement, up to 15%, because the model will weigh more importantly their recent transaction data in the decision. And so what we find is that transaction data can supplement and improve these models very considerably. And for customers that have a limited or transaction history, right, they get a much better performing model because the transaction data is that much important because the traditional methods that exist are not as performant. Now, this is happening across the globe, right? And another example of this is in the United States where I am, right? We had the Ultra FICO score. And the Ultra FICO score is essentially where we supplement with current account data the existing FICO lending score. And the results are pretty impressive. And I think we'll see this across the globe. 7 out of 10 applicants see an improvement in their scores. And over 15 million see that they now can get a credit score where before they were unable to do so. So I hope this has been interesting to you and to show the importance of transaction data in supplementing and improving credit risk decisions. It's a big part of where the industry's going. It's a great enabler for customers that want to get a better outcome. And it's really a glimpse into the future of open banking and credit risk lending decisions in the future. Thank you so much.